before the presentation begins, let me introduce David. David is one of the most recognized finance professionals. He is former vice president of Nasdaq, and now he is creating an innovative investment banking network to make financial advisory and capital more accessible to smaller enterprises. It's a pleasure to have you with us today.
Thank you, Boris. Appreciate it. Nice to be with you. Why don't we go? The title of our presentation is "How Tokenization is Going to Transform Private Markets," and so why don't we get into it? Next slide, Boris. There we go. Okay, just a little bit about us. We're a rapidly growing cloud-based investment bank. We have professionals right now in 17, 18 of the 50 states in the United States already, and we have them in a couple of countries overseas now. And we're pretty rapidly growing. And as I said, we're about probably at around 100 investment bankers this year, and they come out of all sorts of different firms, from Credit Suisse, Lehman Brothers, Barclays, Robertson Stevens, which was one of the old Four Horsemen technology boutiques in Silicon Valley, and so we're following this model to largely fill the void that exists in middle market for middle market investment banks and servicing small and medium enterprises. Next, Boris. There we go. So, these are just some things on my background. As Boris mentioned, I was the former vice chairman of Nasdaq many years ago, and we've had quite a bit of influence over the years. I've spoken at the G20 in Istanbul, the OECD in Paris in Italy, and for them at the Asian Corporate Governance Summit in Tokyo. I just got back from the World Knowledge Forum about a month ago in South Korea. Spoken at the Federation of European Exchanges 1 year when it was held in Zurich, Switzerland, 1 year when it was held in Oslo, Norway, and not infrequently at the SEC and in Congress in the United States. As many of you know, there are a couple of things that we've done that have led to major legislation, including the Jobs Act that gave birth to crowdfunding and other technologies, which are obviously important to developing private securities markets here in the United States, and the FAST Act, which was really a technical corrections bill. Kind of excited about getting to work because the gentleman who is running the transition team for President-elect Biden was actually one of the first advocates for the Jobs Act in the U.S. Senate, and so I've got a fair degree of optimism that we're going to do some things that hopefully will help improve capital formation broadly in the United States, but that remains to be seen. I don't want to jump the gun. And also, Weild & Co. has a blockchain investment banking practice. We've actually got a couple. One of which is called Emergence at Weild & Co., and we're very actively engaged in the space. Next. So, a couple of boards that I sit on, INX, which is the first, it actually got the first token for an operating company approved by the U.S. Securities and Exchange Commission, and it's in the midst of its IPO. This is a pretty interesting company, largely because it was a pioneer going through the Securities and Exchange Commission, and because it's going to make markets in digital assets. It had to go through not just a review to get the token that it's issuing approved and signed off on by the Securities and Exchange Commission, but also had to have its business model reviewed and approved. And so it's a good template for those of you that are sort of interested in how things are being looked at in the United States. CorkNX, which is I'm an advisor to, is a Canadian-based, Toronto-based company, which is an all-in-one platform for private companies. And interestingly, it doesn't actually use tokens. It's a closed-loop system on the block. Next. So, yeah, I was fishing around for growth projections on what tokenization is going to look like, and this is actually one that was published in 2018, and it projects that by 2007 there'll be $24 trillion worth of tokenized assets in the world, which is, rather stupendous. But when you think about just U.S. equities markets, for instance, there's in the public markets alone in the United States, and this is one of the smaller markets, there's already $40 trillion worth of assets just in that one equity pool. So, there's a lot of room to grow here. And if you go through and parse through the detail, the unlisted equity tranche is upwards of $6 trillion projected by 2027, and there are a number of these tranches that are in private markets currently, like home equity and other tokenizable assets. So it's projected to be rather a large, broad scale adoption of technology, and for a number of reasons, because tokens offer some advantages. We'll talk about that in a second. Next, Boris. I hope that got your attention. I urge people not to just focus on the tokens. What's the magic in private markets is really the application layer, what we call smart contracts, where processes are triggered by events, contract conditions, including compliance checks and the like. And so in markets which are largely regulated, and there's a major compliance factor, and particularly when you're looking at going multi-jurisdictional, cross-border, what we have here is a suite of technologies that, when integrated, will allow people to much more cost-effectively navigate capital raises cross-border, and ultimately to be able to trade securities in private markets cross-border without violating securities laws. And so it's going to take down that sort of that inertia, that constipation, and minimize it. That's required high-touch use of very expensive lawyers, and so as a consequence, by taking out reducing much of that friction, it should allow these markets an opportunity to develop. Next. So, what the smart contracts itself are wedged between the token and the block layer, and some of these systems, by the way, don't, which I group into the same category, which are digital markets, are closed loop systems, and they don't actually trade tokens, but they do use smart contracts, and they do use the general ledger. But these are all part of the same family, and the same sort of evolution or revolution that's going on. The advantage of this application of technology is that it gives people autonomy and the availability to ultimately be able to hit a button to execute a trade, which has not really been the case in private markets until recently. We're starting to get there. It also allows you to be compliant. I mentioned the multi-jurisdictional compliance portion of it, which I think is really interesting. And then that you'll be able to trust these systems because documents are all encrypted and generally on a shared ledger. There's backup. I mean, particularly in distributed ledger systems where you can have multiple copies, and so even in the case where there's a nuclear magnetic pulse or solar flare, which would knock out systems, there's a case to be made that if you've got an instance or a node on the other side of the globe, that you'll have backup copies of the technology. And so in some regards, it's more it has the potential to be significantly more resilient. There's also obviously significant savings in terms of elimination of intermediaries, most notably lawyers. And then finally, because things are automated and done on the computer and you're eliminating individuals, there's an elimination of manual errors. The impact to issuers, and some of this may have been cut off, but we're going to expand the reach for capital raises And one of the things that I do advise folks to do is, if you are doing a capital raise, see if you can offer investors both a token option and a traditional security option. Why we are going through this sort of crossing the chasm part, or the adoption phase of the marketplace, because there are some investors that just simply are not yet comfortable owning tokens. And so, I like to say that the customer is always right, and you don't want to tell the customer, who's the investor in this case, that they can only gain exposure to your company in one modality. If you go back years ago, we started out with everything was done in physical stock certificate form, and then we went through electronic centralized delivery. This is sort of, in some regards, part of the evolution, if you will, of settlement and delivery. And it's an interesting and exciting phase, because it should really help crash the cost of transacting in securities in private markets. Next. So, and we talk about components, and I'm just going to give some people a little bit of a framework for how to think about this, but we have trading platforms. Are they open or closed? Issuance platforms, smart contracts, valuation, which I want to drill into a little bit, because this is really important in marketplaces, and blockchain protocols. Whether you're on Hyperfabric Ledger, which is used by many in the financial institutions community, Ethereum protocol, so on and so forth. Valuation, it obviously in opaque, not smaller kinds of bespoke issuances, one of the problems is valuing securities, right? And so, my belief is that most of the successful issuance that's going to sustain attractive prices, if we start to trade in private markets, is easier to value assets, or methodologies that are going to make it much easier to do that research valuation portion of the analysis on a company, or, for example, real estate assets are a lot easier to value, bonds, because of the coupon, the yield-oriented investments, so on and so forth. When you get into sort of story-dependent investments, you need storytellers, and it's really difficult to get those stories out there. It's very high cost, and so we're going to start to see technologies that, get to sort of doing research through artificial intelligence mechanisms. I'm going to talk a little bit about that in one company that's doing that, to drive down the cost of creating sort of research outputs to help investors value stocks in the aftermarket. Next. So here are three companies. The first one is a company that does a form of artificial intelligence research that's actually just starting to be, and by the way, we have relationships with all of these companies. And so that's the reason why we know them the way we do. Crowdsmart does what we call collective intelligence. There is a lab set up at MIT right now, run by a professor named Maloney. And what this platform does is it takes panels of experts, up to 25, and it is seen to outperform individual analysts, individual venture capitalists. And so this technology is increasingly being used by endowment funds, and also as part of the onboarding process for private markets that want to see companies tokenized for trading. And I'm not at liberty to say which of those markets, but there's one on the West Coast, it's based on the West Coast, one on the East Coast right now that are designing this technology in. And it only works with pretty sizable companies at this point, because as you can imagine, if you have to seat a panel of experts do a 360-degree analysis of a company and take their qualitative input and turn it into qualitative outputs and recommendations. It's not inexpensive to do, but it is highly efficacious and it's highly compelling. Another company which is working on commercial real estate, and I find this very interesting because it turns out that a lot of the insurance and other companies that have major real estate assets are largely holding these commercial real estate assets as tier 3 assets, which means that they have to set aside quite a bit of capital on the balance sheet. And so one of the big 4 accounting firms has issued an opinion that this firm's methodology for doing continuous valuations of these of commercial real estate assets will allow companies to recategorize these assets as tier 2 assets and free up capital on their balance sheets, which I think is really a pretty compelling value proposition. As I mentioned before, CoreConnex, which is a company based in Canada, does multi-jurisdictional compliance, but it does blockchain trading and settlement as digital securities without tokens. So it's a closed loop system. And so you're going to see in this marketplace the emergence of open systems where you can trade tokens sort of basically on any trading system, any marketplace. And you're also going to see closed systems where you just get a digital account. It tells you what you own with that particular company. It's traded across the block, but the representation is in the account, and you're not actually given a token. So the revolution, if you will, or the evolution is here. We're seeing more and more of it. Adoption is a little bit slow, I would say, in some areas. I think Europe and Asia have been better at it than maybe the United States. I think that where we're really kind of interested in seeing the market going is where DTCC, which is a centralized digital trust company, this may be counterintuitive to people, will start to accept tokens as deposits, so that then if people purchase tokens, they can be reflected onto their traditional securities accounts. I think if that happens, you're going to see an awful lot of money pour into tokens, and obviously that's good for the business. We just need to make more of the capital that's in the marketplace largely accessible to investment in tokens, and I think that those kinds of changes will really remake the entire market for the better. Next. So I just, this is very typical of emerging technologies. And if you look at the token industry, I just want to give you a sense of what to expect. I mean, we're in the proliferation sort of early phase of this marketplace still right now. You're going to see a lot of innovation. You're going to see a lot of niche development, different kinds of business models. And we're going to kind of quickly move in the next year or two into an accelerating adoption phase where more and more investors and increasingly institutions, as we get comfortable with custody issues, start to feel comfortable in putting money into the market. We're partners with a research group in New York called Multistrat. The founder came out of Morgan Stanley, was head of strategy. They do a lot of macro research. But they also do research in the blockchain area. And it's interesting because their client base, which is largely institutional and some family offices, is increasingly interested in things relating to crypto and tokens. And so, you can start to see just through the subscriptions of research, people doing their homework and increasingly thinking about how they're going to gain exposure to these markets, which is very healthy to pushing that accelerating adoption phase of the market. And at some point, we're going to reach a little bit maturity. That's quite a ways off, but you're going to start to see acquisitions, consolidation, rationalization. And, right now we have an inordinate number of places where you can trade crypto. At some point, you'll start to see that consolidate down and get rationalized. We haven't even gotten to that point in private markets yet. Private markets are obviously lagging the crypto, the traditional crypto market, if I can call that, if that's not an oxymoron. So I think that this is a very, very, very interesting area to right now be an investment banker, to be an entrepreneur. And you're going to see, I think, some really significant benefits ultimately derived by improving private market access. What you will have happen is that some of those trillions and trillions and trillions of dollars worth of public assets will start to, as private markets start to function more like public markets in terms of providing liquidity, you'll see more money get allocated to private markets, which is, from a public policy standpoint, incredibly healthy, because it means that more innovation, entrepreneurship will get funded, which is obviously incredibly important to social impact, job formation, upward mobility in each of our economies, and wealth creation. And so, the real job formation and real technology innovation occurs generally with smaller companies. And so there is always this, this challenge of how do you make more money available to entrepreneurs and make it and lower the bar so that they can ultimately get an exit. The gestation periods for entrepreneurs can be decreased. And I think that one of the largely untalked about benefits of the tokenization movement is that ultimately it will make more money accessible to more entrepreneurs, which is a very, very healthy thing that I think all policymakers should be able to embrace. Okay, Boris?
Thank you for your amazing presentation, and it was very interesting to hear. And actually, you raised an interesting question, because many of the previous speakers and also practicing CEOs of tokenization platforms in the industry mentioned that one of the most exciting industries for tokenization is actually real estate. And you said that you actually rather seen one of the big benefits of tokenization in capital going to early stage companies to help drive innovation. Do you think, and in terms of companies staying in the private markets, early stage companies who are doing the most innovation are not the only ones in the private markets. There is the real estate, which was mentioned by many previous speakers. There are bigger private companies who are just not going public, which may be not very good from the perspective of transparency and corporate governance. So in your opinion, what should be done so that the capital goes specifically to the most innovative companies that are on the private markets?
Well, no, I mean, that's why I think, Boris, that forms of artificial intelligence that can, I'm really interested in Crowdsmart, what Crowdsmart is doing, because, what they do is they seat a panel of 25 experts and they give a 360-degree view on a company, and they take qualitative input and they turn it into quantitative output scores to tell you, whether or not a company is good. I mean, you can start to see that kind of, if you can drive down the price points. Right now probably costs about 25 grand to do a full-blown 360 analysis, but it also provides outputs, has the potential to provide consultative outputs and help people do a better job of running their companies, right? And so I think that what we kind of thirst for is how to value these innovative companies or stories, right? They don't, a lot of times they're pre-revenue in the earliest phase, and they're absolutely essential to kind of plant the seeds for the next generation of companies to grow the economy. And so you need gray matter, inputs to be able to value these things, and you need storytellers. And so there's two things that I think that that will kind of happen simultaneously. One is restructuring our capital markets, right? So that there's an economic incentive for storytellers to get out there and tell stories in the aftermarket, right? Get on the phone with an investor and say, there's a great little company here, you're gonna, this thing is, gonna transform the world. And I'd like, you should think about, buying $500 worth of, tokens, or whatever the case might be. And so the markets have to be structured in a way which is going to support that kind of dialogue and information flow on the one hand. On the other hand, the cost of getting research together needs to be driven down. And I think that that's where artificial intelligence kinds of methodologies will and inputs, whether you crowdsource that information and turn it into actionable outputs. I think that the two go kind of hand in glove. The person's telling the story to an investor to get a buyer to offset a seller, and the research that's actually being performed. And so look, I see components that are going to help transform these markets. And look, in the United States, we got very close to creating a new form of stock exchange called a venture exchange. It was in a bill that was done by Congressman Emmer called the Main Street Growth Act. Congressman Emmer is a Republican in Minnesota, and it was wrapped into an act which was an omnibus bill, was probably even bigger than the Jobs Act in the United States, and it passed the U.S. Congress. It was called the Jobs and Investor Protection Act, or something to that effect, in 2018, and it passed the Congress, the House of Representatives, 406-4. It was incredibly bipartisan. So it shows you that there's an appetite. And it was so bipartisan that the smart money was saying it was going to get tacked on to the Senate Appropriations Bill and passed into law. It was endorsed by Donald Trump in his White House blog statements. He was very pro this particular bill, but then he shut down the government over the wall. And then what happened is there was never a budget to tack the bill onto, and it pushed the legislation into the next Congress, which mooted it, right? It absolutely takes the legislative calendar when you go into a new Congress, and it sets the clock back to zero. So, but there's a lot of nuggets there, and we'll surface that with the new administration, because it was so non-controversial. Maybe we'll get a bill that will actually allow people to start with a whiteboard and restructure public markets so that you can get an IPO done earlier, to your point, right? So that they're not in private markets until they're unicorns. We need to get back to the current head of the transition team for President-elect Biden gave a speech in the U.S. Senate years ago, and the final line was, is if we can get the $25 million IPO to work, we'll put America back into business. And so I think that there's an appetite. I mean, for those of you that don't know, the Jobs Act, which gave birth to crowdfunding in the United States, was actually signed into law by President Obama on April 5th of 2012, right? And so there's been an appetite in both parties to do some of these things. And so I'm cautiously optimistic that we'll be able to get a new form of stock exchange and address some of these issues to make it easier for companies to go public. And that will then all of a sudden make it much more attractive to invest in private companies, because you now lower the hurdle to get an exit, right?
Yeah, that sounds like a working solution. I assume also another important component is tokenized venture funds to get more capital into the private markets at early stages, specifically, because for a common person who wants to put like in $100 or $1,000, paying 25 grants or even a lower amount for AI-based research is too expensive. But if you are putting more money that you gathered into the private markets as a fund, then it's a more reasonable spending. So I assume tokenized funds are an important component into this ecosystem.
Yeah, I think that it may be easier to do in Europe than in the United States. I mean, in the United States, you start to run into 40 Act problems, and there are limitations in the private markets with these funds, typically in terms of how many investors you can have, right? And so you can do things under different kinds of structures. I mean, we probably would have to do some innovation, but there's also another problem, which is if you start to trade a venture capital fund, how do you value that venture capital fund, right? And it's going to be very similar to closed-end equity funds. And I think, as the European community probably knows, I mean, a lot of closed-end equity funds have a history, because they exist in Europe as well as in the United States, have had a history of trading at a big discount to their intrinsic net asset value, right? And so the problem is, you issue it, it has a tendency to trade down. So from an innovation standpoint, by the way, I ran equity new issue new product development at a top 10 firm years ago. So I'm very used to kind of innovating with securities. But you need to do some things sometimes with these funds for instance, to pay a dividend out of equity just to get them to trade better in the aftermarket, to make them more bond-like. We actually did a closed-end fund years ago. It was the Zweig, many years, probably 20 years ago now. But it was a closed-end equity fund investing in public equity securities, and they were all trading it, at a 15-20% discount to their net asset value. And so with Marty Zweig, it was the Zweig fund. We said, got him to agree. He said he could make 10% with his eyes closed every year. So why don't we, why don't we tell people we'll pay a 10% a year distribution, and we'll do it on a quarterly basis. And that closed. It actually had the effect of closing the discount to net asset value up very dramatically. Right? It takes it takes a lot of moxie to do something like that, and a lot of confidence to do something like that. But it had exactly the effect that we wanted it to have, which is to close down the discount to net asset value very quickly. So, there are things that you could do.
I assume it's hard to do from operational perspective. So funds of that kind, they have to have a really big pipeline to be able to take someone public in a smaller exchange each quarter to be able to pay dividends. But I assume in theory it is possible.
Yeah, it is. I mean, look, it's there's a lot of really one of the challenges going forward. If we don't, lower the bar to getting companies public, that we are closing out the market, and where a lot of the alpha is being created, right? The uncorrelated returns are being created in private markets. And so what we've done, and this is a question for policymakers, is that what we really want to do, right? Don't we want to make alpha generating opportunities available to everyone, even those with small amounts of money? And then how do you manage the risk so that they don't get taken advantage of, right? But I think that is something that, at least in the United States, I've seen policymakers, start to debate, because we see all these unicorns that go through their hyper growth phase, and by the time they go public, and it's whether it's Facebook, when Facebook went public, I mean the hyper growth phase is already behind you. And so if you're not an institution or a high net worth individual, you missed that one, right? You didn't have an opportunity. So I think that these are things that will be reset. I mean, the fundamental problem is when we went to all electronic markets, and we it's great to trade innately liquid, large capitalization stocks, but these things don't need liquidity providers. The liquidity providers are needed by smaller capitalization securities, which are where you have a big seller and no buyer. Somebody has to get in the middle and make a market. And if there's no economic model for that market maker to make a living and to manage their risk, then these markets start to fall apart, and investors leave those markets. They move up market, which is exactly what we've seen throughout the world. And that's why the bar has been so dramatically raised on going public. It's absolutely got nothing to do with Sarbanes-Oxley and disclosure requirements. It has to do with the certainty of getting that company public and the risk. And if the risk of failure goes up, which it has because of the changes, the shift over to electronic market and the diminution, the shrinkage in distribution quality with the big investment banks, then you're not going to get a good outcome if you're a smaller company. So you're smart to stay away from public markets. This is why we see SPACs, for instance. SPACs are sort of a sign of this disease, which is, I can create a SPAC and I have certainty of outcome. I can go public, right? People are not concerned at that point about the dilution, the incremental dilution of going public through a SPAC, because they know that if they close on the acquisition, they're going to get their funding. So there's a high certainty of outcome, and entrepreneurs are, they don't want to spend their time on something that's got less than a 50-50 chance of getting done. They got better things to do with their time.
Thank you for your reply. Thank you for a wonderful conversation. We can have it, I assume, for hours, but it's already late, and it is time to proceed to the next section of the conference. So, David, thank you a lot for your speech and for the follow-up discussion.
Nice.
Our viewers can also follow your work a lot, and I hope we have another chance to have a conversation as well. I'm also going to finish our demo now, the demo of the dashboard, which was interrupted by the connection problem. And tomorrow at approximately 3:30 p.m., we are going to, at GMT +2 time, we are going to do the demo again to take care about the connection problem without all interruptions and this stuff. So if you're interested, feel free to join. And this is an invitation to all the
send me a link. So for it tomorrow, and I'll put it on my calendar tomorrow. That'd be great.
Okay, I'll make sure. Thank you again.
Boris, nice to see you.
Have a nice day.
Take care. Yeah, good luck to you. Take care.